Welcome, LinkedIn. My name is Allison Bradshaw, and I'm here with Robbie Sundberg. We're managing directors who lead Embark's ESG and sustainability practice. And we are here with you guys today live to talk about CSRD, Corporate Sustainability Reporting Directive, which is the EU's regulations around ESG and sustainability reporting, and specifically the double materiality assessment that's required under CSRD. So, Robbie, we talk to probably 5 to 10 companies a week looking for guidance around CSRD compliance and double materiality. And in large part, it's a struggle because of the judgment that's required as part of this analysis. And so today we're going to focus on the foundational activities around CSRD compliance, specifically scoping and reporting elections, as well as that double materiality assessment that I alluded to earlier. So these are going to feed into your gap assessments and remediation efforts as you move forward in CSRD compliance. But they're really critical steps to get you off on the right foot towards your CSRD compliance. And so Robbie and I hope that you leave here today with a better understanding of how scoping and reporting elections can impact your approach, as well as some insights into how double materiality assessments are performed in practice at various companies. So please ask questions live in the chat if you have any. We'll do our best to get to them either during the discussion or at the end of the session today. And if not, we'll reach out individually with responses to you over LinkedIn. So with that, Robbie, do you want to set the stage with a quick overview of CSRD before we get into the good stuff?
Yeah, I'd love to, Allison. And so I think this is helpful just to kind of understand the evolution and kind of how we got here. So really the evolution of the EU's sustainability reporting regulations, really building on the non-financial reporting directive, the NFRD. So some of you may be familiar with that directive as well. It was introduced almost a decade ago. It was really the EU's first significant step in requiring companies to disclose non-financial information. However, again, that wasn't that long ago, but it quickly became clear that more robust and really comprehensive reporting standards were needed to meet the growing needs for transparency in ESG matters. And so really enter the CSRD at that point. And the CSRD was approved by the EU Council in November of 2022. It officially went into effect in early 2023. And that really marked a pivotal moment in ESG reporting. And there were some kind of additional kind of changes as it related to the ESRSs and things like that over the course of 23 and really even into this year. But the CSRD really significantly broadened the scope of companies that were impacted as well. So affecting, really nearly 50,000 companies. And just for context, the number under the NFRD was about 11,000. So a much larger number of companies that are impacted.
Yeah, not just European companies, right? So companies all over the world, right? Which is why we're here today talking about this. So definitely has a wide reach across the globe in terms of who's impacted by CSRD.
That's right. That's absolutely right. And another critical component of the CSRD is the European Sustainability Reporting Standards, which really provide the detailed framework for how companies must report on ESG issues. And so the ESRS sets out really the specific disclosures that are required under the CSRD and helps ensure consistency, helps ensure comparability and transparency across companies and industries. The initial set of ESRSs, just by way of very brief background, they're sector agnostic standards at this point, really comprised of 2 cross-cutting standards that provide for general disclosures and requirements. And then there's 10 topical standards as well across environmental, social, and governance. Really, that's just the start from the European Financial Reporting Advisory Group. So that's EFRAG, which we may refer to a little bit as we kind of go through this. But and they've really indicated that there will be also sector-specific standards and also some simplified standards for certain types of companies that will come in the near future. So if I kind of transition kind of after that background, maybe a little bit more around kind of why this matters, and Allison alluded to this, but why this matters really for companies that aren't in the EU and US companies in particular. So again, at first blush, this might seem like we talk about something kind of coming from the EU, it might seem like the CSRD is an issue for companies based in the EU to worry about. And that's true, but it's only partially true. Really understanding that CSRD or understanding the CSRD is really essential for companies for a few reasons. So first, and again, Allison alluded to this, but the reach of the CSRD really goes beyond those companies based or listed in the EU and includes US companies, as well as companies headquartered elsewhere with subsidiaries or other operations in the EU. And so to add to this challenge, if you're a US company, for example, the reach is much broader and comprehensive than what US companies may be accustomed to, whether under maybe some of the voluntary reporting that you're doing, or even emerging SEC and state-specific guidelines that you might be starting to prepare for. The scope is much broader, and so really important to understand CSRD in that context. Again, the level of effort required for compliance is really significant and definitely cannot be underestimated if you're going to be successful. I guess the other point here that I'll make is that, and again, Allison referenced this a bit, but a large number of the conversations that we have on a weekly basis are really centered around, in some way, around CSRD, whether that's the DMA or the gap assessment or kind of data strategies or reporting, wherever that is. It's a lot of those conversations are really centered around the CSRD, and really the largest multinational corporations in the world, those EU listed companies, of course, those have started already to move kind of along their compliance journey, or they're further along in that journey, certainly. But we are also starting to see increased attention from other really large organizations, as well as middle market organizations, as they start to prepare. So again, understanding that preparation needs to start now is just really critical in terms of preparing for those upcoming deadlines.
Yeah, absolutely. It's really kind of the first wave of regulations that is going into effect, right, with the SEC state and some of the other things a little bit delayed. And so companies are really taking that opportunity to focus on CSRD and to spend their time getting that right.
That's exactly right. That's exactly right. And so, really kind of understanding that, I think it's helpful to talk about some of the effective dates as well, as you start to think about compliance. So from an effective date perspective, really CSRD reporting, those effective dates are approaching very rapidly, and much sooner than your similar SEC, California, or some of the other state-specific requirements. We maybe didn't necessarily think that just a few years ago, but here we are. And so the first wave of companies, again, some of those really large multinational companies, or those impacted, or those listed in the EU, those are the companies that have largely, already started reporting, or maybe not started reporting, but preparing for reporting. So they're further along. But those, again, those are the companies largely that perhaps reported under NFRD. So those companies begin reporting in 2025 on 2024 data. So if you're in that category, again, you've likely already, you're pretty far along, likely in the process in terms of complying with the CSRD requirements. If you're not, definitely let's talk about that. But you likely are. But it's really that second wave is where we see quite a bit of variability when it comes to where you're at in terms of preparation for CSRD's requirements. And so that second wave of companies impacted really includes those large and those middle market companies with significant EU operations. So those companies, from a timeline perspective, are required to start reporting in 2026 on 2025 data. There are a couple of additional waves. Again, it won't be really the focus of our time here, but there are a couple of additional waves and timelines that may be relevant for companies that really extends out to 2029, reporting on 2028 data. So maybe that's something we talk about in a future session. But again, what we'll talk about here largely applies regardless of which timeline applies to you. But given the immediate attention that's needed for companies that fall into that second wave, that's really what we'll spend a bit more time as we go through this. So really from a roadmap perspective, just to kind of, I think, further set the stage for the scoping discussion we'll have and the double materiality discussion that we'll have. When we think about companies in that second wave, again, who will report in 2026 on that 2025 data, we really recommend conducting a detailed double materiality assessment, and a comprehensive gap assessment by the end of this year or early next year at the absolute latest. And there's still a lot to do after the DMA. So getting things done kind of along that timeline will give you that sufficient time that you need to address any deficiencies, to establish reporting processes, to establish controls, and really ensure that your company is well positioned for compliance when that time comes, because 2026 isn't very far away. And again, we're talking about 2025 data that you have to report on. So keeping with that timeline will really also enable you to do a dry run in 2025. That's something that we highly recommend companies doing if at all possible. And so that really will ensure that you have the processes ironed out that you'll need to have figured out before kind of that real, if you will, reporting begins in 2026. So I guess with that said, you might be thinking, cool, I know it's important. I know there's a lot to do before I can start to think about any of these things. So I need to understand if I'm impacted by CSRD. And so that's an important question. What exactly triggers that CSRD exposure? And the CSRD is all about, as we kind of touched on, kind of broadening that scope of corporate reporting on sustainability related issues. And so what that means is that more companies than ever will be exposed to CSRD or to sustainability disclosure. And so it's going to be really important to break down that scoping process so you kind of understand how to think about that and whether you might be exposed. So the scoping process under CSRD involves really determining whether your company falls into the directive scope based on a few specific criteria. And again, we'll particularly focus here today on those Wave 2 companies. That's how I'll continue to refer to them, those Wave 2 companies, those large companies that are not based in the EU. And there's really kind of application, the way to think about this is CSRD applies to large companies that meet 2 out of 3 criteria that have been laid out. So the first is more than 250 employees. The second, you have a net turnover of more than 50 million euro.
Yeah, and I think I would add, Robbie, it's important not to go at it alone. There really are legal questions that are involved as part of the assessment as to where and when and who within your organization may be subject to CSRD reporting. And so definitely if you're a finance professional trying to make this evaluation, entity org charts can be complicated. Get your legal group involved to help you do that analysis, because it's not always easy or straightforward. Even though those 3 kind of trigger points sound pretty easy to navigate, it can get complicated really fast. So definitely make sure you're including others in the discussion, and you have everybody who is a stakeholder or who would have a perspective on that involved as part of that discussion.
Yeah, that's helpful, Allison. And maybe to help with this a little bit more, it's really not, I think this is helpful clarity. It's not just about kind of individual entities, but it's also how those entities consolidate. And I kind of referenced that briefly, but you can't simply look at individual subsidiaries on their own. You really also need to consider any other entities that might fall under and consolidate up through that entity. So really what that means is that, just by way of example, you might have a subsidiary in the Netherlands that perhaps doesn't meet the scoping thresholds on a standalone basis, but that sub may have 2 other subs underneath it. Let's say, in France and Germany that don't meet those thresholds, again, on a standalone basis. But then when you look at that Netherlands entity on a consolidated basis, they may reach those thresholds. And that might mean that that Netherlands entity and anything underneath it that consolidates up through it are subject to CSRD. And so hopefully that's a helpful example as well.
Yeah, and I think kind of two things that we've seen in practice, right? We've seen entities where, to exactly your point, they may have a consolidating entity somewhere in Europe, and there may be 60 entities across the globe that really roll up into that from a consolidation perspective. And so your scope and what's included can be much broader than you may have initially thought. I'd also suggest this is also where your legal and your tax organizational charts can be deceiving at times, because you may have branches or divisions in the EU that appear to need to report based on consolidation or otherwise. But really the nature of those entities and what they're subject to already from a reporting perspective can be impactful as to whether or not they actually do need to report under CSRD, which is why I say include legal as much as you can, because it's not always a straightforward or easy answer.
Yeah, super helpful. So once you've determined that CSRD really applies to you, and we're kind of approaching this from kind of a just again from a roadmap perspective, really once you've determined that the CSRD applies to your entity, the next step is really deciding on the reporting approach that you'll take. And so you have a few options here. So there's enterprise level reporting, entity level reporting, or so-called kind of artificial consolidation type of a view. And so really enterprise level reporting is what it sounds like. There's really the ability to report at that global enterprise level, regardless of, the fact that maybe that entity is headquartered in the US, and maybe you could report again at that entity level in Europe, but you've made the decision to report kind of on a global basis. That might make sense in certain situations that we can dive into if it's helpful. But another option that I mentioned, so that entity level reporting, that's pretty straightforward. For individual entities that are in scope, you can report at that level as well. And then the artificial consolidation view that's available as well, it's really where you have the ability to, CSRD really provides this option to select your entities that may be in scope in Europe. And though they may not consolidate for financial reporting purposes or based on your organization structure, you have the ability to really combine those for purposes of your CSRD compliant reporting. And so that option is available as well. And this decision, it really is crucial to land on the answer that is appropriate for your business and where you're at. It's something that should be made with careful consideration, given kind of your company's structure, the CSRD requirements, existing reporting, perhaps a number of different factors to consider. But really understanding kind of where you are from a scope perspective and a reporting approach perspective is really critical. Because it's going to impact all your other preparations downstream from here. It's going to drive your DMA that we'll talk about. It's going to drive your reporting, of course, as well. And so the decision, as well as all of the documentation around those conclusions, becomes really paramount.
Absolutely. I'd also suggest it's probably helpful to include, again, other third parties when you think about auditors and things like that, because ultimately, as this moves towards the assurance requirement, you're going to need buy-in and alignment with those people as you kind of move towards assurance. And I'd consider not just kind of your parent auditor here in the US, but also probably local auditors as well, because as jurisdictions have transposed CSRD, there are some that have either kept or expanded on the current CSRD requirements. And so there are things that even as you're laying out those processes and data collection pieces, you may still need to identify at a legal entity level or a jurisdiction level, despite having taken a different approach for overall reporting under CSRD. And so it's important to really get early in the process buy-in from all the stakeholders who are going to have a say in how and what you're reporting under CSRD.
Absolutely.
Awesome. Well, with that, I think maybe it's a great time for us to shift into discussion around what I think is probably a little more of a hot topic when it comes to CSRD reporting, but the double materiality assessment. It's one we get a ton of questions about, right, Robbie? I think that's because it really is a shift in the way of thinking, particularly for finance and accounting professionals. Because double materiality at its core is really kind of the intersection of two different types of materiality. You have financial materiality, which is very much aligned with what we're used to from an audit perspective and a financial statement perspective. When you think about really what impacts the company in terms of the financial statements. So it could be cash flows, could be a particular asset, could be really anything across your financial statement reporting. And that concept is not so foreign to finance and accounting professionals. However, that's kind of layered on with what CSRD defines as impact materiality, which at its core really tends to be more qualitative in nature than quantitative in nature, although includes aspects of both. But really reflects the actions of the company and how those impact people and the environment and or community around them, right? And so you need both the financial statement impact or financial impact and impact materiality in order to determine what ultimately is material to your company. And CSRD is so kind as to make that an or. So if something is material, either from a financial materiality perspective or from an impact materiality perspective, it would be material under CSRD. And I think specifically, Robbie, that impact materiality is something that's a little bit harder for finance and accounting professionals to wrap their heads around, because when you think about actual or potential positive or negative impacts on people and the environment over not just the short and long term, like we're used to in finance, but also the medium term. And then throw in the fact that that's not just the entity's own operations, but also up and down the value chain, it really expands the concept of materiality and what would be required for companies to report.
Yeah, that's a good point. I think that's something that we spend a lot of time, really, even just from an educational perspective with clients, just kind of talking through what impact materiality in particular, because again, to your point, financial materiality, I think people have a pretty good feel for what that is and represents. But from an impact materiality perspective in particular, we spend a lot of time, and it's really valuable time with companies, stakeholders throughout those organizations, just helping them kind of understand what's intended by this impact materiality consideration.
Yeah, absolutely. Absolutely. So now that we have the kind of the foundation of what double materiality is, I'll give really a quick overview of the guidance around the approach to double materiality. And then we'll talk a little bit about some of the takeaways and things that we've seen in practice working with clients through their double materiality assessments. And so really, I think the most important thing to start off with here is that the guidance from CSRD is not very prescriptive in how you need to perform a double materiality assessment. There are guidelines and frameworks to follow. However, there is a whole lot of judgment built into the process for companies, which is one of the reasons I think it's so challenging for companies to do, especially for the first time, right? And so first, I'll just kind of give that quick high-level summary. The approach to double materiality from a methodology and an approach perspective is you want to align stakeholders and stakeholder engagement around your impacts, risks, and opportunities. So shorthand, we call those the IROS, as well as determine scoring methodology for evaluating those impacts, risks, and opportunities across the organization. And so there's kind of two pieces of that. One is kind of limiting down the world of CSRD data points, which, there's over 1,100 of those throughout the ESRSs, which is a lot. Luckily, they don't expect you to report on all of those, only those that are material in large part. And so really limiting those down through that stakeholder engagement process is really what the double materiality assessment is on its surface. And so the second piece of that I think is challenging for companies is there's not a lot of guidance or prescription around how you need to engage those stakeholders. And so when you think back to the definition of materiality, both from a financial and an impact perspective, it's not just internal stakeholders, there's external stakeholders as well. When you think about suppliers, customers, government organizations, communities, as well as those internally from an investor perspective or employee perspective. And so, as you might imagine, when you have such a wide variety of people and opinions around what is important and what matters, it can be challenging really to evaluate those for companies.
Yeah, the one thing that I'll add there too, Allison touched on just all that stakeholder engagement and the various methods that might make sense for different stakeholder groups. One of the things that we do that we find really helpful is really just building that stakeholder engagement plan, where we really align with our clients in terms of who are the relevant stakeholders. We'll bring our thoughts as well and who we think those relevant stakeholders are, but also engaging with our clients to understand and get their thoughts in terms of what that looks like as well. And then really tailoring based on who those stakeholders are and the company's specific situation and context, build a plan for how we're going to engage with each of the stakeholders, why those stakeholders are relevant, how we're going to weight various stakeholders, et cetera. And so that plan and really establishing that early becomes really valuable throughout the rest of the assessment.
Yeah, absolutely. And that plan looks different, right? Depending on who the stakeholders are, who the company is, and how they're approaching that, right? You guys listening will see a theme here. There's a lot of the typical accounting answer. It depends that goes into how things are structured, right? Which is nice, right? Because it gives you as a company a lot of flexibility in how you execute your double materiality assessment, but can make it challenging as well because then there is a lot of judgment involved. But what we see with our clients, Robbie, we see from a mechanism perspective for engaging those stakeholders, we see everything from hours-long interviews or workshops with those SMEs or stakeholders across an organization to quick surveys, light touches, or confirming information kind of already obtained. But one of the things that I think we can agree from our conversations that we've had previously is really critical is that it be based in objective evidence, right? It's not judgmental in what it is. You need to have a methodology and an approach that you can support and that you can point to ultimately support the conclusions that you're reached, which means ultimately you need evidence to help support those. And you can gather those through interviews, which I tend to think are the most effective at gathering those evidence because you can have a real conversation about what and why things matter. Although a really well-made survey can accomplish the same results. So that's one of the things that we see being done pretty wildly differently across our client base.
Yeah, and that's with intention, right? Again, because different approaches make sense for different stakeholders and for different organizations. So they all look different, but that's a good thing. That allows us to get to the most accurate and supportable conclusions.
Yeah, no, and I think you've said it best when we've had some other conversations. Not only can they look different, they should look different because every company is different, and so how they approach that should look different as they're doing that analysis. And so that's, I think, one of the biggest takeaways we've seen, not just from our clients, but also from the EFRAG study around some of the early reporters under CSRD. But I think shifting to another one for me was really the use of those subject matter experts across the organization, right? Most companies, when you think about their enterprise risk management program or enterprise risk program, they have people who are experts in what a lot of ESG and sustainable reporting is, right? When you think about a manufacturing company, they have people who report on health and safety and know that inside and out because that's their job on a daily basis. You have people who real estate is their area of expertise, and knowing and understanding the impact on the land and the community around it is their expertise. And so I think a lot of people get caught up in the new requirements around CSRD and forget that a lot of this is really happening across their organization already. And being able to leverage and utilize those is really important because that means you can take what's coming out of your double materiality assessment and your ESG and sustainability reporting and really weave it into the overall strategy of your organization, which I think we would all agree that the best governed companies do those effectively, right?
Yep, that's right.
And so that I think is another really, really, really important point and takeaway from what we've seen with CSRD and double materiality specifically. I think the other one that probably unsurprisingly, but I don't know that all companies have fully prepared for it, is just the level of resources and support and knowledge that are necessary to track all of this stuff, to report on all of this stuff, and to even perform your double materiality assessment itself, right? And I think those really kind of come in three forms. The first being just people, right? Arms and legs to help execute on the requirements of the double materiality assessment and CSRD specifically. But it also comes in form of knowledge, right? Historically, there haven't been a ton of sustainability experts and professionals in the world. And so a lot of companies are struggling and reach out to us for help when they don't either have people or the knowledge base to perform a lot of these required compliance exercises under CSRD. And so that's something as people go through both the transition period and think about steady state in the future, they're really kind of struggling with. And then I think the third for me is technology, right? As with everything else in this world, technology has a huge space in not just the double materiality assessment itself, but ESG reporting generally. But Robbie, what are your thoughts on how IT can help impact the double materiality assessment specifically?
Yeah, I mean, I think technology obviously critical in a number of processes that we've talked about. I mean, from a DMA perspective, in particular, since that was your question, I think one thing to keep in mind as it relates to the double materiality assessment process that we didn't specifically highlight, but it's not just the reporting that's subject to limited assurance with that phase in towards reasonable assurance, but your DMA itself is subject to assurance. And so what that means is the conclusions that you reach are going to be subject to an assurance process. And so ensuring that you have clearly documented conclusions and you have something that's auditable becomes really important. And to the extent you can leverage technology throughout your process, but in the DMA included, you're able to better support those conclusions. You have that end-to-end audit trail with regard to your double materiality assessment. So what that means is you reach these conclusions over here in terms of what's material for you and what therefore is required from a disclosure perspective. But if you kind of walk that back to the source and everything kind of along the way, all of that needs to be auditable. You need to be able to kind of show how you reached the conclusions that you reached. And to the extent that you can leverage technology in terms of the assessment process itself, the various stakeholder, the results of the stakeholder engagement that you performed, how you weighted stakeholders, the scales that you used, and you can really bring all of that into a technology platform. And we're happy to have those discussions about how to do that in a more specific way. But you can really help facilitate that auditability, not to mention the repeatability of the process, because repeatability is important as well. This double materiality assessment process is something that does need to be refreshed each year. And so creating a process that is enabled by technology for that repeatability is really important as well, even beyond just the auditability element. And then if you think beyond, I mean, I know we talked about DMA. If you think beyond DMA in terms of technology, obviously from a reporting perspective, XBRL tagging is required. So that electronic tagging is required as part of the CSRD compliant reporting that you ultimately do in the jurisdictions where you're in scope. And so leveraging technology to facilitate that process becomes really important. Data collection, of course, as much automation. Again, you want to have that end-to-end audit trail as much as possible. You want to have efficiency. You want to have a scalable process that's going to continue to be able to grow with you and as your needs expand. And so technology, really, really powerful tool and something that is more and more not just a nice to have, but a necessity.
Yeah. No, absolutely. It's going to be critical as people kind of move forward with CSRD and sustainability reporting more generally. Absolutely. And then I think really the last takeaway I have from what we've seen with double materiality assessments is really there has been a tendency for some companies to what I'll call over-report or over-conclude around materiality. And to me, that's really something that a really good, robust double materiality assessment can help you prevent, right? And there's two reasons I think you don't want to do that, over-reporting and kind of take that conservative approach. Is one, it's a lot of work to gather the information and relevant data points around various topics for ESG and sustainability reporting. And so if it's not actually relevant or material to you as a company, you really don't want to spend your time and resources pulling together information that's not important, right? More information isn't always better if it's not relevant or material to you as a company. And so I would just highlight specifically that the double materiality assessment and doing a thoughtful evidence-based assessment there really can help prevent that, which is really, really, really important when you think about things. The second point there is the whole purpose of ESG and sustainability reporting and the CSRD directive is that the intention is to report things that investors and the community and users of your products or your services would be interested in, right? And so to my point about more information isn't always better, you don't necessarily want to inundate the market or people with too much information around things that are not relevant and not material. And so you want to keep it limited to what is and focus on what's important and spend your time and resources on what matters. Anything I missed that you would add from a key takeaways or findings or themes that we've seen across double materiality assessments?
No, I don't think so. I mean, I think really one of the things that you may be taking away, but if not, would definitely want you to take away is that each of these situations is unique. So, the approach that makes sense for you is going to be unique. And so, we would want to tailor that to your specific circumstance and have a really specific conversation with you around what could make sense for you if you're trying to figure out where you go now that you kind of understand what you have to do, but you're not sure how to get there. We'd love to have that conversation. So I guess really, hopefully the discussion around scoping and the double materiality assessment process was helpful. Again, we maybe mentioned this at the beginning, but we do have more content coming your way covering other CSRD preparation topics in various formats. But just maybe a quick preview of some of that. So really after you've completed or you've identified your in-scope entities, you've concluded on your reporting approach, you've completed your double materiality assessment. That kind of takes you through the things that we talked about today. At that point, it's really time to identify where you have gaps. And then once you've identified where you have gaps, it's time to prioritize those gaps and really establish a plan for remediating each of those. And prioritization there really important. We can dive into that more, but you also need to establish, there's obviously a lot of data involved here. We talked about the potential 1,100 data points. Again, not all of those are going to be material, but clearly data is really important. So establishing and really enhancing to the extent you already have one, but that data capture strategy and the processes that you have in place to ensure you're able to collect all the data that you ultimately need to collect in an efficient manner and a timely manner. We didn't touch on this, but in this time, but that reporting timeline is quick, and it's much quicker than I think than companies that are reporting on a voluntary basis certainly maybe used to. If they're taking 6-7 months to report today, you don't have that much time from a CSRD reporting perspective. And so really getting those processes in place, getting those controls in place, that governance in place becomes really important. Again, ultimately, you do have to report this information. So that also is something to keep kind of in the back of your mind or perhaps top of mind, and really kind of that integrated reporting that's required. So that financial information alongside the non-financial, and again, from an XBRL perspective, all of this will need to be tagged. So that becomes really important as well. So I guess really what I would say from a from a, I guess, call to action perspective, if you will, it was really, get started as soon as possible. One, follow us on LinkedIn, follow Embark on LinkedIn. We have more content coming your way that I think will be really helpful just as you kind of start to think through this. Of course, we'd always love to have the conversation as well, but either approach, we'd love to continue to engage.
Perfect. And this was the time we had expected to kind of shift into Q&A. However, I don't see any of those at the moment. So I'll just do a quick, short and sweet recap, largely aligned with what Robbie just said. Get started and don't hesitate to reach out to Robbie or I or Embark at large to get help with the process. Everyone's navigating this for the first time. And so it is helpful to engage people who have seen this across other organizations and other industries to help navigate through this process. And so don't hesitate, connect with us on LinkedIn, and we'll look forward to seeing you guys next time.